Market Recap. I'm Daniel.
And I'm Mira.
Usually, when you're looking at a trading screen, there's, a certain rhythm to the numbers, like a push and pull that actually makes logical sense.
Right, like a seesaw. You see a massive tech rally, and maybe bonds dip a little bit just to compensate.
Exactly. It operates like a seesaw. But occasionally, you get a day where that seesaw just snaps right in half.
Yeah, and Monday, July 13th, 2026, was definitely that kind of day.
It really was. We are looking at a market that just woke up and realized its two biggest foundational assumptions, cheap energy and easing inflation, might actually be completely dead.
Totally dead.
I mean, we watch Nasdaq futures just get dragged violently down from that massive 30,000 threshold. Meanwhile, Brent crude soared past $83 a barrel.
It was honestly an absolute breaking point for the market's underlying logic. So in today's deep dive, we're going to unpack the total collapse of the Hormuz ceasefire.
Which was huge.
Right. And then we'll dissect the Federal Reserve's hawkish warnings on inflation and explore exactly what this dual shock means for your technology and energy allocations.
Yeah, it's a lot to cover, but just to set the ground rules before we jump into the timeline, this deep dive is strictly for market context and educational discussion. It is not personal investment advice or, a recommendation for your portfolio.
Gotta keep the lawyers happy.
Always. All right, so to kick things off, we've got to start with our first session. So what set the stage before the U.S. session?
Well, to really understand the sheer panic of Monday morning, you have to look at what unraveled over the weekend.
Right.
We've been covering that fragile June ceasefire over the Strait of Hormuz in our prior sessions, but by Sunday, it was completely coming apart at the seams.
It escalated so fast.
It did. So at 5:12 p.m. Eastern Time on Sunday, July 12th, U.S. forces launched these intense air and sea strikes targeting Iranian coastal radar and missile assets.
And from a military technology standpoint, we actually saw a fascinating first there, right?
Yeah, exactly. The U.S. deployed combat sea drones for the first time, basically these uncrewed surface vessels carrying heavy payloads, and they hit coastal cities like Bandar Abbas.
Wow.
But, and this is crucial, military commanders explicitly stated they intentionally avoided targeting the vital oil exporting infrastructure on Karg Island.
Okay, I want to view that specific detail through a game theoretic lens for a second, because the reflex for most investors is to see geopolitical disruption in the Middle East and just instantly price in total unpredictable chaos.
Oh, for sure. Pure panic.
Right. But by striking the military radar systems and deliberately sparing the oil terminals on Karg Island, this is a calculated application of geopolitical disruption as game theory bargaining leverage.
Interesting.
Yeah, I mean, the U.S. is demonstrating they can hit the coast with these new sea drones at will while keeping the global crude supply intact. They're trying to squeeze the opponent without actually breaking the global oil market.
I mean, that might be the strategy on paper, but the market just did not buy the premise that this is a controllable situation.
They never do they?
Nope. And Iran's retaliation proved that controlled escalation is, often just a myth. At 11:13 p.m. Eastern Time on Sunday, Iran launched drone and missile strikes against U.S. military installations in Kuwait and Bahrain.
Wow, so hitting neighboring Gulf nations.
Exactly. And they hit early warning radar systems in Oman. Hitting those bases instantly broadens the theater of conflict.
It definitely does. And the immediate result of that was just a massive flood of risk-off sentiment hitting the pre-market.
Oh, absolutely. S&P 500 and Nasdaq 100 futures began to tumble the exact moment those retaliatory strikes crossed the wire.
And, the real tragedy for the technology bulls is that this geopolitical shadow completely overshadowed some genuinely incredible fundamental data out of Asia.
Oh, the South Korean number.
Yes. Earlier that evening, we received South Korean export data for the period of July 1st to July 10th, and it showed a 53.9% year-over-year surge.
That is just a massive jump.
Right. And it was driven overwhelmingly by AI semiconductor demand for manufacturing giants like Samsung and SK Hynix. In a vacuum, a 54% jump in chip exports proves that the physical hardware build-out for AI supercomputing is aggressively accelerating.
It really does.
That data alone should have sent the Nasdaq flying.
It really should have. But macro conditions always trump micro fundamentals. The institutional money essentially decided that explosive semiconductor demand simply doesn't matter if, the shipping lanes used to transport those chips are under physical threat.
Not to mention the baseline energy required to manufacture them.
Exactly.
Well, that perfectly frames the overnight narrative. We had equity futures sliding, energy bubbling, and tech fundamentals completely ignored.
Pretty bleak setup.
It was. So that wraps up our look at the pre-market. We're going to take a super quick break and then move directly into the cash open.
Stick around.
All right, we are back. Moving into our second session, what moved markets during U.S. trading hours?
Well, the morning handed us just a massive structural geopolitical headline.
Oh, yeah.
At 8:11 a.m. Eastern Time on Monday, July 13th, the U.S. announced a comprehensive naval blockade of all Iranian ports and coastlines.
And when does that actually go into effect?
This blockade is scheduled to officially begin on Tuesday at 4 p.m. Eastern Time. So that's 20:00 GMT.
Got it. And adding absolute fuel to that fire, President Trump simultaneously proposed a 20% compulsory transit toll on all commercial cargo passing through the Strait of Hormuz.
Basically to pay for U.S. maritime security.
Right, which is just unprecedented.
And it triggered an immediate and aggressive legal pushback. The UN Shipping Agency and various regional allies quickly stated that there is zero legal basis under international maritime law to impose compulsory tolls for streets used in international navigation.
I mean, yeah, you can't just set up a toll booth in international water.
You really can't. But honestly, the debate over maritime law didn't matter to the trading algorithms. The market damage was done the second the words blockade and toll hit the terminal.
We saw the visceral reaction in the energy pits instantly. Brent crude spiked 9.4% to $83.15 a barrel.
Massive move.
Yeah, while WTI hit $77.96. And the supply fears were compounded less than an hour later. Yemen's Houthis targeted Saudi Arabia's Abha airport at 9:25 a.m. Eastern Time.
Which forced a total suspension of regional commercial flights. Right?
Exactly. This is really where the macro meets the micro for every portfolio. We know that oil and diesel shocks function as a mechanical tax on the global economy.
Oh, absolutely.
But today, we saw the market aggressively price in that margin compression in real time.
Because it touches everything. It is literally a tax on every physical good that moves.
Yeah.
I mean, if you are a consumer discretionary company trying to manage, say, holiday logistics, your baseline fuel cost just skyrocketed.
Yep.
And the purchasing power of your customer base just shrank because they are paying way more at the pump. And that mechanical tax feeds directly into the second major shock of the day, which came from the Federal Reserve.
Right. At 12:29 p.m. Eastern Time, Fed Governor Christopher Waller delivered a remarkably hawkish strike.
What did he say exactly?
He warned that while headline inflation might ease slightly, if we get a hot core CPI print this week, it could force the central bank to actually resume rate hikes.
Wow. Resume hikes.
Yeah. He specifically blamed tariffs, the Middle East energy shock, and massive AI expansion demand for keeping inflation so sticky.
You know, the immediate market reaction was violent, but I have to wonder if investors took the bait just a little too easily.
How do you mean?
Well, think about the timing. The Fed knows the energy shock is happening in real time. Is Waller's threat of an actual rate hike a genuine policy roadmap, or is this just the Fed trying to aggressively jawbone inflation expectations down?
So you think they might be bluffing?
I mean, they might just be talking tough to keep financial conditions tight without having to actually pull the trigger on a hike that could break the Treasury market.
It's tempting to view it as a bluff, for sure. But look at the specific catalysts Waller cited. Tariffs, the Middle East energy shock, and the physical constraints of AI power demand.
Right, those are physical, real-world supply constraints.
Exactly. The Fed cannot drill for more oil, and they cannot build more electrical substations for data centers. The only tool they have to fight supply-side inflation is to aggressively destroy demand.
That's a grim thought.
It is. If Waller is staring down physical constraints, he might actually be forced to hike.
And the bond market certainly believed he was serious. It treated Waller's comments as a total global liquidity vacuum.
Yields just took off.
Yeah, when a Fed governor threatens rate hikes into the teeth of an energy shock, institutional capital flees to the absolute safest yield it can find. We saw the 10-year Treasury yield surge to 4.609%.
Which brings us to the most fascinating price action of the day, honestly. Traditionally, the textbook tells you that gold is the ultimate safe haven during a geopolitical war.
Right. Gold is supposed to be the bunker.
Exactly. But gold suffered a brutal $118 faceplant today, plunging all the way down to $4,008.70 an ounce.
It perfectly illustrates the brutal reality of opportunity cost. When real yields spike violently, holding a non-yielding asset like gold becomes incredibly expensive.
Right.
Investors look at gold yielding 0% versus the U.S. government offering a risk-free 4.6% on the 10-year, and they just dump the metal instantly.
And speaking of government actions, we received the final reality check just as the trading day ended.
Oh, right, the formal notification.
Yeah, at 4:00 p.m. Eastern Time, so moments after the cash close, Trump formally notified Congress of a new war against Iran under the War Powers Resolution. He stated that U.S. forces would hit Iran extremely hard.
The timing on that is just wild.
Yeah, so the U.S. session effectively ended in a severe, localized flight to safety. S&P 500 futures closed down at $7,554.000. Nasdaq futures closed near their session lows at $29,433.60.
And credit spreads widened significantly, too.
They did. Corporate bond ETFs like LQD and HYG slid downward as risk premiums just blew out.
It was a punishing dual shock narrative. Geopolitics squeezing the supply side and the Fed threatening to squeeze the demand side.
Exactly.
So that wraps up the broader market action. We'll take one more quick breather and then shift our focus to the company level.
See you in a second.
All right, we're back. Let's pivot to the micro for our third session. What is the corporate events recap, and what should we watch next?
Well, despite the absolute macro chaos we just walked through, the infrastructure build-out for artificial intelligence continues to plow forward.
The train does not stop.
It really doesn't. At 5:30 a.m. Eastern Time on Monday, Meta announced a $40 billion expansion for its Louisiana AI data center.
$40 billion.
Yes. They are aiming for a colossal 5 gigawatts of compute capacity. To put that in perspective, 5 gigawatts is the equivalent output of several nuclear reactors, dedicated entirely to a single data center campus.
That's just staggering.
Yeah.
It really reinforces the reality that AI CapEx is entirely cycle agnostic at this point. These mega cap tech companies view this infrastructure as existential. They're going to spend through the cycle completely regardless of whether the Fed is hiking rates or the geopolitical landscape is fracturing.
Yet even that cycle-agnostic spending couldn't save the sector's price action today. The technology sector ETF, XLK, still closed down nearly 1%.
Really?
Yeah, it just couldn't escape the discount rate acting as gravity on equity multiples. When the 10-year yield rockets to 4.6%, the present value of all those future AI earnings gets heavily discounted.
The gravity of the bond market is just undefeated.
Yeah.
But there was another subtle, highly consequential tech story that hit the wire at 10:27 a.m. Eastern Time.
Oh, the regulation story.
Yes. The Trump administration and the AI industry are currently in deep discussions regarding a strategic open-source model licensing framework.
And what would that actually do?
Well, the proposed idea is to essentially cap the capabilities of U.S. open-source models to match the capability ceilings of Chinese models.
Wow. Think about the downstream effect of that regulation. On the surface, I mean, it's pitched as a national security measure to prevent adversaries from downloading state-of-the-art American AI code.
Right, which sounds reasonable.
But practically, if you legally cap the capabilities of open-source software, you inadvertently build an impenetrable regulatory moat for incumbent tech giants.
Oh, it's the ultimate gift to the incumbents.
Right.
Companies like Meta, Alphabet, and Microsoft already have highly advanced closed proprietary models.
Right.
And a massive chunk of the grassroots developer community relies on open source alternatives to compete with those giants.
So if you cap the open source...
Exactly. If the government steps in and permanently restricts how smart the open source alternatives can get, you are freezing out grassroots competition. You lock in the market dominance of the incumbents under the guise of national security.
It's honestly a brilliant, quiet consolidation of power.
It really is.
Now, before we look ahead to tomorrow's catalysts, I believe we have our closing bell joke to cap off this brutal trading day.
We absolutely need some dark humor today, so here we go. Well, folks, that is the closing bell on a day where the only thing escalating faster than the military's new combat sea drones was the price of Brent crude.
Ain't that the truth?
If you try to run to safe havens, gold suffered a brutal $118 drop, proving there was truly nowhere to hide.
Nowhere at all.
Between President Trump proposing a 20% cargo toll and Fed Governor Waller comparing inflation to porn by saying, you know it when you see it, It seems Washington and the Fed want to charge us extra just for watching the climax.
Oh boy.
Put your screens on standby, pour a drink, and let's pray tomorrow's CPI print is strictly PG rated.
We can only hope. Because looking at what to watch next over the coming 24 hours, the catalysts are massive.
What's first on the docket?
First, Tuesday at 8:30 a.m. Eastern Time, we get the highly anticipated June CPI and core CPI data. That single data point is going to dictate everything regarding Governor Waller's rate hike threats.
Yeah, that's going to be a huge print. Also on Tuesday pre-market, we have major Q2 bank earnings rolling in from JP Morgan, Citigroup, Wells Fargo, and Goldman Sachs.
Which is going to be fascinating.
Definitely. We've talked extensively about yield curve steepening as a massive bank balance sheet risk. Tomorrow morning, we get to see exactly how much damage that steepening is actually doing to their margins.
Can't wait. Then at 10 a.m. Eastern Time, Fed Chair Kevin Warsh delivers his semi-annual monetary policy report to the House.
The whole street will be watching that.
Well, right. Everyone will be listening to see if he backs up Waller's hawkish tone or if he, walks it back. And finally, Tuesday at 4 p.m. Eastern Time, that is the exact moment the U.S. naval blockade of Iranian ports officially begins.
Just a completely packed 24 hours.